Welcome. This is John Persinos, Editorial Director of Investing Daily, with a video update for Monday, October 26. Democratic presidential candidate Joe Biden intoned ominously at last Thursday's debate with President Trump that America faces a, quote, dark winter because of rising coronavirus deaths during the flu season. Could the phrase dark winter also apply to the stock market? In today's video, I review the past week and try to get a handle on what lies ahead. With 1 week to go until Election Day, investors stand on the cusp of a treacherous time. Earnings, politics, and the economy could all start deteriorating simultaneously, driving stocks lower. The nation is focused on the presidential race, but Wall Street last week was whipsawed by negotiations in Congress over fiscal stimulus. Stocks rose and fell according to how talks progressed. The main indices closed the week lower as it became clear that lawmakers were gridlocked. Take a look at the following table. Yes, the November 3 elections matter, but the greatest drivers of the stock market will be economic growth and corporate earnings. As of October 23, nearly 30% of companies in the S&P 500 have reported actual results for the third quarter of 2020. The blended year-over-year earnings decline stands at minus 16.5, according to data compiled by FactSet. Two sectors, health care and consumer staples, are reporting year-over-year earnings growth. The other 9 sectors are reporting a year-over-year decline in earnings, led by the energy and industrial sectors. The following chart breaks down Q3 earnings growth to date, sector by sector. This week, 183 S&P 500 companies, including 10 Dow components, are scheduled to report results for the third quarter. Among them are the 5 largest stocks in the S&P 500 index: Alphabet, Amazon, Apple, Facebook, and Microsoft. Combined, these tech behemoths comprise more than 20% of the weighting of the S&P 500 index. Their earnings results will prove pivotal for the future direction of the entire stock market. So will forthcoming economic data. The economic docket is particularly crowded this week, with the most important market-moving data scheduled for release on Thursday and Friday. Take a look at my third graphic. We might not know who won the White House or perhaps even the Senate until long after the voting. A disputed election would roil the stock market. If Wall Street hates anything, it's uncertainty. We face short-term volatility because of uncertainty, but once the dust settles, the stock market's long-term prospects are strong. The Federal Reserve has signaled that it will maintain accommodative monetary policy for the next few years, a powerful tailwind for investors, regardless of which party is in power. Remember, the world was shocked when Donald Trump won the presidency in 2016, but after the election, the S&P 500 underwent a robust rally and rose more than 20% in 2017. Since the end of World War II, the average stock market return in the 4 years between presidential elections is 37%. I'm bullish on 2021, but between now and the new year, we face a perilous interim period. Stay invested, but until the election is over, stay cautious. Well, that does it for today. If you have any questions or comments, send an email to mailbag@investingdaily.com. Thanks for watching. See you next week.